Weekly fundamental forecast for U.S. stocks. Inflation data have attracted a lot of attention since the release of the minutes of the FOMC meeting and NFP advertisement the first week of the year proved to be disappointing for the U.S. dollar, while the DXY index added plus 0.07%. Most of its gains were given back by the end of the week following the middling December U.S. jobs report. Euro to U.S. dollar rates finished lower by minus 0.20%. While US dollar to Japanese yen rates added plus 0.33%, with risk appetite fading. High beta pairs like Australian dollar to US dollar and NZD/USD fell back by minus 1.24% and minus 1.07%, respectively. Pound sterling to US dollar rates bucked the trend, gaining plus 0.39%, with the holidays official in the rearview mirror. The turn into the second week of January brings about a supersaturated U.S. economic docket. Not only are there several high-ranked data releases due in the coming days, there are testimonies and speeches by several Federal Reserve policymakers that seem destined to introduce more volatility to financial markets in the wake of the December Fed meeting minute. Based on the data received thus far about 21, the Atlanta Fed GDP Now growth forecast is now at plus 6.7% annualized, down from plus 7.4% on January 4. Our recent releases from the U.S. Bureau of Economic Analysis, the U.S. Census Bureau, and the Institute for Supply Management have weighed down U.S. growth expectations as the COVID-19 Omicron variant infection rate has surged in recent weeks. The next update to the 21 Atlanta Fed GDP Now growth forecast is due on Monday, January 10th, after November U.S. wholesale inventories data are released. For full U.S. economic data forecasts, view the Daily FX economic calendar. We can measure whether a Fed rate hike is being priced in using Eurodollar contracts by examining the difference in borrowing costs for commercial banks over a specific time horizon in the future. Chart 2 below showcases the difference in borrowing costs, the spread, for the January 2022 and December 2023 contracts, in order to gauge where interest rates are headed by December 2023. By comparing Fed rate hike odds with the U.S. Treasury 2s5s10s butterfly, we can gauge whether or not the bond market is acting in a manner consistent with what occurred in 2013/2014, when the Fed signaled its intention to taper its QE program. The 2s5s10s butterfly measures non-parallel shifts in the U.S. yield curve, and if history is accurate, this means that intermediate rates should rise faster than short-end or long-end rates. There are 161.75 BPS of rate hikes discounted through the end of 2023, while the 2s5s10s butterfly is just off of its widest spread since the Fed taper talk began in June. After the December Fed meeting minutes and December U.S. NFP report, rates markets are effectively pricing in a 100% chance of 625 BPS rate hikes and a 47% chance of 725 BPS rate hikes through the end of next year, the most aggressive Fed rate pricing seen during the pandemic thus far. Historically speaking, the combined impact of rising U.S. Treasury yields, particularly as intermediate rates outpace short-end and long-end rates, alongside elevated Fed rate hike odds, has produced a favorable trading environment for the U.S. dollar. Finally, looking at positioning, according to the CFTC's COT for the week ended December 7th, speculators decreased their net long U.S. dollar positions to 39,057 contracts from 36,775 contracts. Net long U.S. dollar positioning continues to hold near its highest level since October 2019, when the DXY index was trading above 98.00. Failure by the DXY index to push higher despite rising U.S. Treasury yields and increasing Fed rate hike odds may be symptomatic of an oversaturated futures market. Written by Christopher Vecchio, CFA, Senior Strategist.